Welcome to another infographic instant with Brian Michael. In this episode, we're going to be asking whether integrated financial regulators help achieve better financial sector outcomes. This infographic is from a paper where we look at the costs and benefits of financial sector integration, particularly integrating financial regulators. And in that paper, we argue for a Twin Peaks approach to financial sector regulation in Hong Kong based merely on the experience of other countries and their experience with financial regulator integration and on the costs and benefits of such integration. Now, turning our attention to the infographic, we see there's two parts of the infographic. The top part and the bottom part both reflecting the traditional division of responsibilities in financial regulation from policymaking and from quote-unquote law enforcement or policing financial markets. Looking at the top part of the infographic, we compare the extent of prudential regulatory integration and risk premia charged for various assets across countries. These data look mostly like a ball, but we see a couple of outliers which suggest that integration of financial regulators could correlate with decreasing risk premia for investments in these countries. And of course, that means that if financial regulator integration leads to decreasing risk premia, then clearly countries should prefer such integration because investments in these countries are less risky. And we know that there's many factors, of course, determining such a risk premium, such as trade balance, government balance, and a whole host of other factors. However, we know that in general, financial regulators can help make up for some of these distortions or problems. And this is a view from theory rather than from experience, but we know that in theory, even if financial markets and the country's macroeconomy in general are very distorted, then financial regulatory policy could help twist or undistort those particular macroeconomic and financial sector distortions, for example, by raising collateral requirements, reserve requirements, and so forth, such that even though the financial sector in general operates in a very dysfunctional environment, because these macroprudential regulations are so effective, then we would see a decrease in risk premia. Therefore, risk premia reflect not only the quality of financial markets in a particular country, but also reflect the quality of the regulators themselves. Thus, to that extent, we would expect to see over the long term some kind of correlation, after controlling for other factors, between the integration and overall quality of financial regulation and risk premia charged for investments in that jurisdiction. Now, looking at the bottom part of the infographic, this shows financial regulator integration and a broad proxy for the quote-unquote rule of law. And we see that the trend is that more law-abiding countries tend to favor integration, and of course the causality could be the other way around, such that countries with higher rule of law prefer integration rather than integration actually leading to increased rule of law, particularly in financial sector. However, to the extent that these correlations hold true, these data do nothing more than imply that integration is better, particularly for policing financial market transactors. So stepping back and thinking about the moral of both of these infographics, it's probably that integration likely affects market-wide risks and returns, and it's up to researchers to discover what those effects are. This has been another infographic instant with Brian Michael.